what is happening right now to me probably has more of a rhyme to 2008 than it does 2020.
We saw a 6% low to high move in like 30 minutes just now.
Every retail trader is going to feel the pain.
Craziest day I've seen in a long time in markets. Craziest day I've seen in a long time in markets.
For
Down
sure.
5%, back to break even for some of the indices, was up just a second ago, back to flat. Crazy, crazy stuff. And I might be seeing you this Thursday too. That's crazy.
Very possible. I'll finalize everything for the trip. Like I said, I probably not the greatest time to be like, let's just have a casual week away from the markets. So that's probably not the case. But I'll turn it in. I'll turn it into work week. But it's a good reason for me to get out of the office for a couple of days. And it's always easy to work remote. So yeah, if I roll in, I think Thursday would be a good time to spend with you guys in the office, and then I'll probably head up towards Augusta, Georgia on Friday.
Yeah.
Yep.
Would be awesome. Chris, we're having some, I think people in the chat are saying the same thing, but TradingView is slow this morning. I think
Agree.
There's so many people staring at these charts.
Yep.
Their servers might be giving out, but we'll do the best we can for the listeners. Give me your breakdown. What do we do with a market like this? Tanking straight down 20%, positive headlines hit the fan here this morning, and we're just seeing volatility in both directions. How are you playing this?
Look, the way I'm taking this is you can take all your high VIX summaries and your, what looks to be the past and stay the course and all this. None of it matters. None of it matters right now. The only thing you can do is control your risk, control the trades and the strategies you're deploying, and survive the day. I mean, longer term, I'm taking some bites. I strongly believe this is going to settle at some point, but it's not now. I mean, all this is today is lots of volume and lots of volatility. Nick, I mean, all we really bounced off of today was the previous 2021, 2022 high. That's why I'm not surprised to see the technical move. But I don't really see a reassurance in the market to say this is great. I mean, somebody told me this morning, oh, the rumor mill that they're going to push tariffs out 90 days. Look, I saw fake Trump tweets over the weekend. It's like there could be all sorts of noise in the markets. Look, last week, Friday was a systemic type day. I didn't hear China come groveling back and say, "Oh, I'm sorry, U.S. We're going to come negotiating." No, that didn't happen. Japan is saying we're going to do what's best. We want to see the U.S. basically remove tariffs from Japan, right? So it's like some allies are holding their ground, and I don't think this is the way it's intended to play out. I mean, it is. Again, you're going to remember this forever, like Liberation Day / what the hell just happened here. We just dropped double digits in 3 days, and it's going to hit it's baffling that since 2018 this is the type of nonsense that traders have had to deal with, right? I mean, Volmageddon 2018 followed by all-time highs, followed by COVID, followed by melt up through COVID, followed by the great 2022 reset, followed by two years of bull markets, followed by Trump, followed by this. It's like, but nobody knows how this plays out. So if you're trying to be a hero and thinking, a buddy just texted me and said, "Hey, is this a good time to buy?" I'm just like, I mean, long-term, yes, but don't dump all your dry powder. To me, this is not a time to say, I'm going to get brave, because look, what is happening right now to me probably has more of a rhyme to 2008 than it does 2020. And 2008 was down 56%. So I'm not calling a 20% bottom at all. Nobody knows how this is going to play out.
Well, Chris, you said it well there in terms of how I feel about it too. I've been getting a lot of those same texts. I'm sure you spent the weekend with some of that inbound messages from loved ones, from friends. Hey, is this bottoming out, or is this a opportunity? Right. And I would agree fully. Long term, I think you're actually getting for the first time in a long time, some prices for the people, if you will. People have been missed out. The average person, inflation kicked their butt in 2022, and finally you've got stocks down 25%. But I think you said it well. That getting triggered does not magically mean, oh, and now markets go back up. Right. So I do actually think that, from my perspective, I've been saying this, short-term trading opportunities I'm definitely not bullish the NASDAQ. Like I need more solid, higher lows, some structure to be put in, some lows to be formed for trades to take place. But I'm with you on the long term. Like dry powder is the name of the game. I've never been more thankful, Chris, about recently having a high amount of dry powder. We talked about that for a long time on streams together, conversations. Yep. I'm still accumulating shares and will happily continue to do so if this market does see 30, 35, 40% downside. We've talked about this for a long term. This is the thing that I think a lot of people have been waiting for, is a true panic event where people who have missed out on the markets for the long term. Again, I think you can look at this as a long-term, probably just fine opportunity, but that does not mean a short-term, rip your face right back up sharp move. I think that we may be looking at a U. We launched the EdgeFinder 3 years ago in April of 2022. And now, years later, the tool has helped thousands of traders take their fundamental analysis and sentiment analysis to the next level. Traders can track things like the commitment of traders data, which shows institutional money flow, whether they're buying or selling certain assets like gold and currencies and indices. Additionally, we've made economic heat maps that allow traders to track easily the fundamental or economic data trends that we're seeing in markets right now. You can also track retail positioning and see what the market sentiment on your favorite assets are right now to look for some contrarian signals. And of course, it strings it all together with the top setups algorithm, showing traders the most convicted top ideas that the EdgeFinder is producing now. The EdgeFinder has helped traders go from beginner to pro in terms of the fundamentals, and has helped many traders go from unprofitable to finding the missing pieces in the name EdgeFinder. So if you're not already using the EdgeFinder, let me tell you about the biggest discount that we offer all year long, starting right now. The 3-year anniversary sale is going to be our biggest discount that we offer all year long, and it is now available to people who are watching right at this moment. Traders looking to get access to the EdgeFinder can take advantage of this massive discount for a limited time using the link in the chat being dropped right now or in the description of this live stream. If you've been thinking about getting a copy of the EdgeFinder, do not miss this opportunity. It is the lowest price that we do all year long, and it's a one-time payment to get access to the tool. So don't miss it. Celebrate 3 years with us by getting yourself a copy of the EdgeFinder at the super discounted prices. Thanks for watching. And now back to the show.
Yeah, I could see. I mean, I could pull up charts of past like kind of ugly bottoms where if you show my screen here, this is why I wasn't super excited about the weekend, because what I noticed were the tape readings on Friday was that retail traders were still net long and still buying, and so this like, oh, it's down 15%, buy the dip. That's fine, but so this makes me feel like the retail crowd has not felt the pain of getting flushed out and kind of bullied out of the market. And that might be the 20. I mean, we're at 21% from peak to trough right now. It might be 30%. If this market, and a lot of this kind of behaves like a tuning fork. If you hit the tuning fork, it has one big wave, and that's essentially what we did here. We had like a little high low, lower high, lower low. But if this is our next wave down, I could see this to this, to this, to this. If we're lucky, it just kind of stays the course here to carve out the lows. But I think we're going to play some games around this bottom. We're going to play some games here. It's obviously good resistance becoming support. So if it holds there, then sure, maybe we find a bottoming pattern here, Nick. And that would be, like you said, a U-shaped recovery, something that looks like price confirmation will be good. Because the only other thing that's going to be faster would be we dump like so. We come up here and we go sideways, and then you're talking, hey, this might be a cup and handle. Well, if we break those highs, how about this, Nick? Would you still short this market if we came back up to 54, 55? Would you still be interested in maybe a short back down to the lows?
I think that if I was to get short, that would be the spot, right? Yeah. I think that the thing that I've been pointing out is like, I think that if you're trying to buy puts at these levels, just like standalone, like a bearish speculative bet that it's going to go lower, I think that's a really, really difficult trade, because you are working with some very high premiums that you have to overcome before you even get into a profitable position. So I don't think that's the case. What do we see right here, Chris? We actually saw the put to call ratio go from extremely bearish to right in the middle, smack dab in the middle, moderate. And then that was a wonderful opportunity. If you were bearish, that was your chance, right? So if you're bearish still, I think that you probably, even if you have a great reasoning for being bearish, I think that doesn't mean you chase. So if you get a corrective move, that's probably even like a what's the 61.8 and then like 78 point whatever.
Yep.
Like you may get that kind of move. But yeah, I think that's a way better risk to reward if you're a bear than selling into the collapse. We saw a 6% low to high move in like 30 minutes just now because we had one sign of maybe some negotiations from EU. So that's the point, is you have to be really careful as a bull and a bear in this moment.
Yeah, I was gonna say on the hedging. I mean, I'm planning on reapplying shorts. I mean, I've been hedged since these highs. I reapplied here just in case. A lot of my hedges are out to August. A lot of them out to September. I put on some fresh ones over the weekend, and I did get paid. I put a $5 debit on the SPY that paid out for $10 credit today. I'm out of that trade, which I'm glad I am. But I'm gonna recycle those trades. And again, for me, I'm not looking to get like short. What I'm looking to do is I'll hedge. I mean, I still think I can battle through this market. I don't know if that's necessarily the low, but similar to what we had, this is just now the doors are like open, right? Like the volatility doors have been blown off. So unless this is going to calm down, I don't think these wild and crazy swings and days. It's like, just like I said, risk capital and risk management is probably the most important thing. I know it's tempting, right? But I'm still sitting on lots of cash. I'm still sitting on over a third of my accounts in cash. So I'm not going crazy to deploy it. And also because premiums are so high. I mean, look at the VIX today. Hopefully everything. Yeah. I mean, the VIX, we had a
17%.
It's like we're talking about the volatility event we had on August 5th. That's how high it pushed up today. And so, I mean, our traders automatically assuming that this is going to go down. And this is another thing. There's no guarantee in the VIX. Like, I mean, the VIX has been higher. It was higher during COVID. It was higher, as high as Great Financial Crisis. I mean, this was 85 in the VIX. Is that the highest? No, Great Financial Crisis, 95. I mean, and there's no reason for it to stop necessarily. I mean, Nick, would it surprise you if the VIX is somehow registering like 100 during this era with like things moving faster and more crazy, that we could have a higher VIX? So this idea of, the VIX is at 45 and just sell, and 1 year out it's positive, and 3 years out it's positive, that might be true. But if we're facing something that has never been done before, i.e. Great Financial Crisis was financial Armageddon, the brink of the entire market coming down. This has similar pieces to it. Like, this is stopping all globalization in like 1 week, and 1 week with Liberation Day. And I know it's not the case. Like, I know the intention was we're trying to bring people to the table, we're trying to negotiate. Like, I get it, but how this is playing out is so violent that I don't think the VIX necessarily has to say, the top was in, because what makes that special? Nothing. Like, I just feel like we're going to be in this year of like outliers, and it's going to be the most extreme bullish day, and it's the most extreme bearish day. So just don't do anything stupid, man. I mean, I'm a long ways away from all-time highs for the year. I'm going to fight the good fight. I'll survive this, but I want to have cash at the ready. And there will be levels that, like, if we're down, 30%, 40%, 50%, then I'm taking long-term plays. I'll deploy probably half of that capital and, plan for the best. But it's still going to be a lot of options, still going to be taking good defined risk trades.
I mean,
there's no reason to do anything silly.
The thing you said, Chris, that really stuck out to me, and for everybody in the audience that I think should hear too, don't do anything stupid. Like I said this earlier. What's the name of the game? How do you get through this? Well, nobody on this stream, nobody in politics, nobody anywhere can tell you with certainty what is coming next in this story. Right. So what can you do? Well, you can control if you do something stupid, right? That's something you can control today, right now. Everybody can do that to improve their chances of survival. The way to get through this, as you just described, if we see 30, 40, 50% corrections in the stock market, which historically have happened, if that's the environment that we're going in, everyone in this room should ask themselves, how am I prepared for that? Because it could happen. So if it happens, how are you prepared? Well, the answer is, number one, don't do anything stupid. No extreme amounts of leverage. Chris and I have been preaching on this show for some time, the effects of dry powder, being prepared for an environment. I mean, Chris, I think you and we know what to do in that scenario. It doesn't mean it's going to be pretty.
Right.
I might lose an arm and a leg through that process, but
Right.
it's gonna be, we know what we're supposed to do, right? You're supposed to accumulate things slowly, little to no leverage. In your case, you like to hedge things out. For me, I like to really trade momentum on different things. I like to mix in more currencies. You do a little bit of that as well. So, there's we're going to survive through this. It's not necessarily going to be pretty, but that's what great traders do. For everybody listening, great traders doesn't mean every single day is green on the portfolio and it's amazing and it's sitting on the beach, pina coladas. That is so nonsense. If you're going to survive this, right, it's going to be like a battlefield and you're going to come out surviving because you were defensively positioned.
Yeah, look, this is straight up survival. I mean, to be here's an example. Yesterday, Tasty Live, they start a futures market opens at 6 p.m. Eastern time.
I watch that sometimes.
They start a live session. I mean, you have traders that have put in 20, 30, 40 years of their life dedicated to the markets, and even they are like, we don't know what this is going to be. Like, so part of it is just crisis management. Part of it is just like talking traders down off the ledge because, the one scary thing about these financial markets is they continue to add more layers upon layers upon layers. I mean, there's only, let's say, $100 trillion of global wealth, but there's $400 trillion of leverage. So that deleveraging event, that bubble at some point can be this burst. And I think what's scary about this right now is that it shows how systemic and how correlated everything actually is. Because on Friday, I think I've got a screenshot of this, Nick, but the world was red on Friday. This is everything from 88% of all stocks declining on Friday. This is the world. Everything was red on Friday. And so again, this is why I'm saying it's not just a COVID thing. Like, this is 2008. This is very, very disruptive for the entire global economy. And also, I mean, think about what this is putting every investor through. Hedge funds are going to blow up. There's going to be liquidations all over the globe right now. And nobody comes out of this happy, but those that can survive it will probably be really prosperous. But that's the thing is, if you don't survive, you're just a statistic.
That's the thing. You'll if you are defensive, your sizing is appropriate, you're not leveraged, you'll come out of it, period. A lot of people will not come out of it. That's the difference. Is it doesn't mean it's going to be pretty. And that's the thing that I think a lot of traders are going to miss.
I mean, every stream we've done since Liberation Day has been a little bit crazier and a little bit crazier. And what we have noticed here is that the market is way more vulnerable over the weekend than it is during one day to the next. So I wasn't surprised. That's why I showed the screenshot, right? That little retail. Again, this screenshot here. Where the heck did it go? This guy. I don't know if I got a chance to talk about this, but I think I did. This was the retail positioning on Friday last week. Okay. That's why I said I'm not really excited about where these markets are going, because if retail investors that have been convinced and conditioned to buy the dip, there's not enough pain for them to be feeling this, and I don't know where that pain is. Like, we've already experienced this, 15, 20% drawdown, 20+%. I mean, Russell is freaking toast right now, but I'm telling you, like, this market has a way of pushing the thresholds to the extremes that every retail trader is going to feel the pain, right? Every institution is going to feel the pain. Like, the traders that come out of this are survivors. I mean, I'm reading like Bill Ackman, longtime Pershing Square hedge fund manager, billions of dollars. One of his biggest plays is Google, and they could be liquidated on their position, right? So, I mean, you're going to see a lot of losses and a lot of ugliness going on that's just not worth the unnecessary risk. So I'm just telling you from experience, throw all of your statistics, all of your probabilities, all of what you think it did in the past, just throw it out the window. I'm not saying that things don't work, okay? But I'm saying we don't know how this ends. So the most important thing is, here's what I'll say. If this market is down 50%, could you survive? Right? So if this market is down 50%, could you survive? Because right now, yes, I can make a case for, well, we have resistance here. Well, we bounced off of that and had a giant swing, but you can see that price is quickly up and then came right back down to the halfway point. So this bottom is not in, right? And if we're lucky, I would say this market kind of overshoots comes back up, maybe if we're lucky, creating a tradable bullish pattern. But this is the type of market where I think if we're going to find lows, it's going to be after a stab and another stab and another stab, and it's going to be something like this, where this market is going to settle in, rip up here, maybe come back down and revisit the lows again, and it's going to be very, very noisy before this bottom is in and before we're justifying a run back to these highs. Okay, I don't think this trades like COVID. I think this is more like, this is systemic risk. And this is also the scary part about the entire financial market, is it shows how interrelated it actually is. And as much as I'd like to say, this is like a rude awakening for everyone to say, look, trading shouldn't feel like this, right? Investing in the world, investing in the most profitable companies in the world, investing in what's supposed to be making people wealthier, it just shows how closely connected it all is. And so if the US catches a cold, the world potentially gets the flu, and you'd think like, well, that's when everyone's going to come back to the US and say, oh, we want to fix this. It's like, look, the US started it. So I don't think that the world is just begging right now to fix things when the US is digging its heels in as well. So that's what's like literal about this trade war, is I don't know how the terms soften up. If we don't hear, I mean, it's like if all of a sudden Trump this week, like today, for example, he starts backpedaling, like you're seeing the fake news, right? I mean, I've already had several comments in the stream, fake news on the 90-day push. I understand why. It's like, this is what we live in. It's misinformation. It's whatever, right? It's all crap. Price is going to be your ultimate tutor and teacher. But if the US is all of a sudden going to flip the script after 3 or 4 days, then it's a bluff, right? And you can say like, well, that's just brilliant. No, it's not. That is the most like distasteful way to do some type of global trade deal, is to basically bully, threaten, and bluff. Like, you know how much credibility you would lose in that negotiation? Which is why I think other countries are willing to stand firm right now and see, okay, look, US is under pressure, markets are crumbling, ours are too, but in principle, they're willing to play hardball, and that's how this thing gets worse. So, great financial crisis probably is the closest rhyme to this, and I know back in 2000 and 2008, which I traded through, 50+% happens, So I'm not calling 50+%. I mean, obviously, I don't want to see that happen, but my point is, if it were to happen, can you survive? If this market's all the way down to 3,000 in the S&P, could you survive it? And what's even sillier is from a longer term trend line, and this is so dumb that this would happen, but this longer term trend line would actually technically make a lot of sense, right? If you have a low here from 2008, okay, and you have a low during COVID, this low and this low, okay, and somehow if price fell in a straight line, well, 3,200 to 3,000 is that bottoming point. Now, I did crunch some numbers over the weekend. The forward earnings on the S&P, everyone was worried about that, right? The S&P price to earnings was trading around 25, 26. The Cape-Shiller ratio, crazy high. Valuations, all-time highs, or getting up there like into those like bubbly territories. The market's never really bottomed at a 19 times earnings, ever. Usually when the market's finding bottoms, it's been like a reset of like the 23, 24, 25 price to earnings all the way down to like a 15 or 16. Just put this number on your little sticky notes. That's around a 4,000 S&P right now. That's around 4,000. So this bottom's not in, because here's the next piece. This is all trade war noise. Now is trade war noise. Next is we have earnings season that starts this week. Earnings this week. Let me try to find a screenshot here. Let's go. I'll just go. Well, Friday is what I'm watching for. Let's go StockTwits earnings, because StockTwits earnings for Friday, it's only 8 companies reporting, but listen to these names: BlackRock, Wells Fargo, JP Morgan Chase, Morgan Stanley. We're starting off with some big banks, and their tone is not going to be optimistic right now. I mean, Jamie Dimon, I've got an article right here. JP Morgan raising likelihood of recession 40 to 60%. Like, all these things are in question. Nobody knows. They can always point the finger and blame. None of it's going to help. What I'm saying is earnings is the next shoe to drop, right? So trade war noise is now, and it's already so damaging. You take earnings and you see that companies are extremely fearful. All that's going to do is revise things lower. If you think that this market's going to roll over into a recession, here is your biggest takeaway. And we don't really know this data until probably after September. So if there's any type of resiliency in the market, the federal government is pushing out all their layoffs until September. So the data that we read is like, oh, the federal layoffs. Well, if Main Street is going to feel layoffs before then, this is one thing to watch. This is a boring little indicator that prints every Thursday. Nobody pays attention to it. But if these jobless claims start going higher, okay, then what we are doing is we're stacking on trade war uncertainty, okay, which is taking on global friction and global economy suffering, because it literally halts globalization as we know it. And then you take on U.S. earnings, which are probably going to be revised lower, likely revised lower. And then you take on job losses. And on top of that, you throw in sticky inflation. Okay, possibly sticky inflation. You throw on a Fed reaction. Okay, the Fed put is not now. The emergency measure of the Fed to be reactive is not at a 20% pullback. The Fed would step in if we're on the brink of a financial freaking collapse, like we were in 2008. That's a 40, 50, 60. Who the fuck knows? It could be 50, 60% lower. It could be 80% lower. Nobody knows. But the emergency measures is not now. Now, from 2008, we've learned a lot. There's been a lot of stress tests put in place and a lot of mechanisms put in place where we shouldn't really have to experience the 2008 all over again. We shouldn't have to. But the cycles can be faster and uglier, right? So you throw job losses on top of that. This is the thing to watch. Like, all these things add up to the worst case scenario. And so right now, this is happening, right? Global trade war. Okay. So that's happening. More global friction until it's resolved, until there's more, like open communication. This is happening. U.S. earnings has yet to really be seen as revised lower. Everyone knows it's coming. It just hasn't been priced in. Well, now the market's dropping. The S&P is a good barometer for the markets. It always has been. But clearly, Wall Street and the economy are very different things, right? Main Street, Wall Street, Main Street, very different. But job losses have yet to tick up. The federal government's kind of suppressing that data because most people are getting paid through September, even though they've been fired. They're just not on. They're not showing up as data points until September. And if they don't go back into the workforce, or they struggle to go back in the workforce, then this starts to spike higher, right? Sticky inflation, we will see. True inflation readings are lower. That's encouraging. But tariffs is inflationary. If we're talking about onshoring, the whole reason of globalization is you do things that we can't do, so we want to buy from you. But now we're going to say, well, you do that, we don't like it, we're going to bring it back to us. There's no way the U.S. can pay for everything to be made here. We're not going to make avocados. We're not going to make mangoes. We're not going to import bananas. It's like, sure, we want to do essential infrastructure like semiconductors, building our cars, sure. But we don't make jeans, textiles, everything that we consume on a day-to-day basis. Like, half the crap, 90% of the stuff's not made here. But tariffs is going to cause more global friction. It's going to cause stickier inflation. Prices are going up. And the question is, are producers going to take out that higher cost, tariff cost, and try to pass it on to the consumer? Because if it goes from producer to buyer and we're paying for it, then it's obviously inflationary, prices go higher. But all this is why I'd say this is probably the closest resemblance to 2008. And I don't know how bad it gets. I hope that there is a lid on it, but I don't know. And I'd rather not I'd rather not dig my feet in and say there's no way the market can go lower. If I take a huge risk right now and the market goes lower, that's on me. If I take little tiny fractional risks, I can survive. Like right now, if I'm going to blow up like all of my trades right now, if I blow up all my trades, I'm probably still maintaining a less than 10% drawdown, realistically. I know the trades I take, a lot of my risks are always like quarter 1%, maybe half 1%. And that's showing up like in red. That's like all of my accounts, all my positions open, and they're all kind of blown out to worst case scenario. And that's okay. But my levels are still pretty fine. It's just, I need price and time to settle down a little bit. So there's a lot ahead. What I'm looking for is in the next, let's say, I'll say this. I think I talked to Nick about this last week. If you remember, COVID played out during 2020. Okay, COVID was a full cycle, and if you don't think options are so important in the market now, then COVID is your lesson. Because what happened during 2020 was we had basically the world is ending as we know it, and the market went from one monthly cycle from February to March. Okay, look at this. The world is ending as we know it, and this market went from a high around Thursday the 20th in February to a low of around the 20th of March. That's essentially one monthly expiration to the next before the market bottoms. Okay, guess what our monthly cycle is now? Guess what it is now? April 17th. So it's not this Friday, but it's next Friday, right? Because this market is so much faster than it has been in the past, I wouldn't be terribly surprised if there's a very noisy week this week. We should have inflation data coming this week on Wednesday, Thursday, if I'm not mistaken. New Zealand looking to cut rates. Okay, Wednesday, FOMC meeting minutes at 2 p.m. That'll be interesting. Thursday, CPI data. Is there no PPI? Yeah, so they moved it to Thursday, Friday for whatever reason. But we do have the inflation numbers coming this week. You can see that the year-over-year CPI headline is supposed to be 2.6. Okay, I mean, maybe it is lower. It's still not 2%. Is it enough to make the Fed act and say we're going to cut rates? Well, it's already forecast now we're going to see 4 or 5 cuts this year by the Fed. So everything according to this, you got to ignore the nonsense right now because prices are down so much, but it's not going to force the Fed to do anything, right? The Fed is going to stay, hey, look, we now have the data to say we can start cutting rates, but an emergency cut will probably have the same influence that last September had, which is Fed cuts rates, bond markets do the exact opposite. Okay, so I think right now the Fed should do nothing other than just stay the course, see if the data is coming in as it should, that they can slowly lower rates this year, right? They can soften the cycle if inflation is improving. I think inflation should be the Fed's number one priority. The stock market is not the Fed's priority. It's really not. It's funny right now that the president went from being the biggest cheerleader back in 2016-17 as the market's making all-time highs, look at how awesome this is, to now stabilizing the bond market, trying to lower treasury yields, trying to get this air pocket of liquidity in a better place in the next 4 or 5, 6 months, which is why I see the purpose of this crazy crash in the first place. But to then immediately start to chirp about, come on, Fed, do the right thing. Like, I think that was fake this morning. I don't think that was a real Trump account that did that. But if that starts to be the noise, then you have a president that's now trying to jawbone the economy back up. That's not going to work either. Like, this is going to have to settle somehow, and we're still a long ways from it. All these things have to get played out, and that's what I'm saying. Like, this could be a very ugly, wild. We could be up to 53, 54, 5,500, come all the way back down to these lows again, and just make everyone's head spin. But I will say this: if I have opportunities to re-hedge up here and see it play out back to the downside, there's good opportunities there. If I resell and redeploy some capital down here, take some stabs at it, define risk, I can make some money there. Eventually, when the dust settles, if we can spot some bigger bullish pattern, it's easier to trade. I'm going out 12 to 24 months. Cool. We survive it. We maybe pull in some nice short-term trades in the interim. And when it's all said and done, we survive number one and we make some money on top of that. That's all good.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.